Hey, it's Nate with Navigator Bookkeeping here with the next video in the business structure series. So we've talked about sole proprietorships, we've talked about partnerships, and we've talked about LLCs. But today we're going to talk about S-Corps, which interestingly are not a business structure. They're actually an election. And I don't mean a political election, I mean a tax election. So what is an S-Corp? It's basically a different way to be taxed as an LLC. So if you set up an LLC, you're taxed by default as a sole proprietorship or as a partnership, depending on how many people you have in the business, but not as an S-Corp. That's not the default. So if you do elect to be taxed as an S-Corp, it's actually going to change the amount of tax that you're going to pay primarily in a positive way, as long as you're making enough money. So let's talk about how you would be taxed if you weren't an S-Corp. If you set up an LLC, by default, you're a sole proprietorship. So that means that all the income is going to be passed through to your personal tax return, and you're going to actually pay self-employment tax on all that income, which is not good because that means you're actually being doubly taxed. You're paying the employer and the employee side in a lot of ways. So you're going to pay a pretty high tax rate compared to someone who's just getting payroll wages. So that's not good. If you elect as an S Corp, you can actually avoid some of that double taxation. So the first part is you're going to pay yourself a reasonable salary, air quotes by the IRS, as a employee of the business. What I mean by a reasonable salary is that you need to pay yourself about the industry standard for someone else in your position. So if you own a counseling practice, you need to pay yourself about what someone with similar education to you would make as an employee. So that's the first part. That reasonable salary is a must. If you don't do that, you can actually get your S Corp classification taken away, and the IRS is being really picky on this, so very important that you do this part. So you're going to pay yourself a reasonable salary. This is just going to happen through payroll, just like you would pay any other employee of the business. So you're just going to pay normal taxes on that. The cool part is that on top of that, any additional profits can be paid to you, the business owner, as a dividend. And what that means is that you're going to be taxed on that dividend at a much lower rate than you would if you were taking tax as a sole proprietor, if you were getting paid through payroll, things like that. So that's where the tax advantage comes in. The dividends can be taxed at a much lower rate. And then the money that you're paying yourself through payroll is going to be a business expense as well. So that's actually going to lower the profit that's coming through the business. So you're going to pay yourself two separate ways, two separate methods there. Part's going to be the reasonable salary through payroll. Part's going to be the dividends on top of that. The payroll needs to be the reasonable salary. If it's not, like I said, the IRS is potentially going to come after you and fine you and not be happy with you and all that bad stuff. And then part of it can be the dividends, which are going to be the lower tax rate. So the important part to remember here is that an S Corp is not its own business structure. It's attached to an LLC, and it's something that you elect to do as a business owner. Now, what are the downsides of an S Corp? Well, pretty much paperwork. It's not easy to set up and file. You have to put a lot of paperwork out. If you're going to do it through an attorney, you're going to have to pay them. If you do it yourself, it's going to take you, some hours and some time to figure out how to do that correctly. So the setup is not great. It's relatively expensive. You have to pay some fees to do that. And then the ongoing work and paperwork is also a lot more formal than if you're just being set up as a regular LLC as a sole proprietor. As a sole proprietor, you're pretty free to do whatever you want through the year as long as you pay your annual filing fee, and do that once a year. As an S Corp, you have to put out formal financial statements. You have to hold meetings, have minutes. There's a lot of formal classifications with that. An important part is having accurate and up-to-date financials. So a little shameless plug, if you don't have bookkeeping, check out our website. We can help you with that. But it's important to get that going because S Corps are a lot more formal in their obligations in that sense. So that's the downside of an S Corp, more formal, more paperwork, more obligations throughout the year. But the upside is you can potentially save a lot of money on taxes. So it is very beneficial if your business is pretty profitable. Probably not something you want to do as your business is just starting out. Something you only want to do as your business becomes quite profitable. I'd say when you get to around the $75,000, $100,000 in profit a year, that's when you may want to start thinking about this. If you're above that, my goodness, run over to S Corps. They're going to save you a lot in taxes because you'll be able to set this up and pay a lot less in your tax rate. So that's S Corps. Pretty cool. Not too many people know about them. And like I said, if you have a successful business, I definitely consider using them. And as with LLCs as well, you do have to keep your personal and business finances separate and try to separate those as much as possible. If it's not separate, you can actually lose your LLC protections, which means that if bad things happen with the business, that can transfer over to your personal finances and your personal life as well. So that is the same as well. Remember, the business structure is still an LLC. You're just electing to be taxed as an S Corp instead. So this is great. It feels a little complicated, but sometimes good things can be complicated, and S Corps, I would say, are in that boat. They're a little complicated, but they can save you a lot in taxes. So if you have any questions, definitely would love to hear them. Let me know. But otherwise, we'll see you in the next video.